Equinix generated $2.44 billion in total revenue, yet their free cash flow plunged to a deeply negative $596 million. How can a company with massive top-line growth burn cash so rapidly? Is this digital empire quietly suffocating, or is the market ignoring a fundamental truth? When doing stock market analysis, we must look past the headlines to uncover the real story. Looking at the $378 million in first quarter annualized gross bookings reveals the sheer scale of the artificial intelligence land grab. Annualized gross bookings measure the yearly value of newly signed contracts. This $378 million metric represents the largest sales quarter in company history. Dig deeper and you find that 60% of these large deals are directly tied to artificial intelligence workloads. Hyperscalers are signing contracts to secure physical infrastructure like massive server farms. The golden rule for value investing is that true recurring revenue growth insulates a business from economic slowdowns. By locking in these contracts, Equinix ensures that even if corporate technology budgets tighten, rent gets paid. To grasp why this is happening, look at their immense pricing power. Operating margin expanded remarkably to 23.6% in the first quarter. Operating margin tells us how much profit a company makes before paying interest and taxes. Wall Street is captivated by the fact that adjusted EBITDA hit a record $1.25 billion. That staggering number translates to an adjusted EBITDA margin of 51%. Headlines scream about this impressive profit growth, but the real story is how Equinix defends margins against energy costs. As power procurement costs rise, Equinix seamlessly passes these operational costs onto their captive customer base. Net income reached $415 million, rising 21% year over year. Growing net income and maintaining a 51% adjusted EBITDA margin, despite supply chain constraints, signals extraordinary pricing power. Your investing strategy should target businesses that dictate terms to customers rather than begging for loyalty. This brings us to the elephant in the room, which is the sheer cost of building this empire. Free cash flow came in at a negative $596 million for the quarter. Free cash flow is money left over after a company pays for operating expenses and capital investments. The consensus view is to panic when a real estate trust burns this much cash. But the fundamental reality is that capital expenditures surged to $1.26 billion. That represents a massive 67% year-over-year spike in capital expenditures as the company aggressively buys equipment. Equinix is pouring this capital into constructing new server facilities to capture the computing wave. To maintain market dominance over peers, Equinix must constantly build physical data centers. This extreme capital intensity guarantees that Equinix remains reliant on external financing for the foreseeable future. This is why relying on one metric in fundamental analysis is incredibly dangerous. A negative free cash flow figure looks terrifying, but here it represents a calculated land grab. We must ask how leadership views this ongoing cash burn, leading us to their forward projections. Management confidently raised full-year 2026 revenue guidance to a range of $10.15 billion to $10.25 billion. The crowd assumes this is corporate optimism, but you must look at the bottom line projections. Equinix boosted their full-year AFFO per share guidance to $43.11 at the high end. Adjusted funds from operations is the lifeblood metric for any real estate trust because it measures cash generated after maintaining properties. By projecting an AFFO per share guidance of $43.11, leadership assures the market that their operational leverage is structural. Diluted earnings per share hit $4.20 for the quarter, offering proof of stability. That translates to a 20% year-over-year increase in diluted earnings per share. This forward-looking optimism locks in higher market expectations and demands incredible execution from the management team. The lesson for your investing strategy is that strong forward guidance can outweigh short-term cash deficits, provided the company delivers. Delivering on massive promises requires serious capital, exposing the underlying vulnerability of Equinix. Total debt principal outstanding climbed to $22.08 billion during the quarter. This borrowing spree pushed the debt-to-equity ratio up to 1.54 times. The debt-to-equity ratio compares total liabilities to shareholder equity to show how aggressively a company finances its growth. Equinix leaned heavily on debt markets to fund this massive expansion. Specifically, Equinix secured $1.49 billion in proceeds from senior notes to keep the momentum going. Taking on billions in debt feels incredibly risky when interest rates fluctuate. However, the fundamental truth is that robust operating cash flow of $717 million comfortably covers immediate costs. Equinix reported $148 million in quarterly interest expense, proving they can manage the current burden. Equinix generates enough operational cash to service its debt easily, but relying heavily on capital markets introduces long-term vulnerability. The current ratio stands at a healthy 1.18 times, showing they hold enough short-term liquid assets to meet immediate liabilities. While they can meet short-term obligations, undeniable long-term leverage is something every value investor must monitor. If global borrowing conditions tighten, Equinix could face higher costs to fund its next wave of infrastructure. As an investor doing fundamental analysis, you must weigh the cost of debt against the return on invested capital. This delicate balance between debt and aggressive growth brings us to a fascinating dynamic for retail investors. Equinix successfully distributed $519 million in dividend payments to shareholders this quarter. Many observers call this a massive win for income investors, ignoring the heavy operational cash burn we discussed. How does Equinix pay $500 million in dividends while free cash flow remains deeply negative? The answer lies in their highly conservative 48.7% AFFO payout ratio. The AFFO payout ratio tells us what percentage of cash is returned to shareholders as dividends. This AFFO payout ratio of 48.7% proves the dividend is completely covered by core operations rather than borrowed money. Equinix is pacifying dividend-seeking shareholders with a projected $2.04 billion full-year expected cash dividend. They give cash back to investors while aggressively funding their growth strategy through global debt markets. The golden rule for value investing is to verify if a real estate dividend is supported by operating metrics. Equinix is walking a financial tightrope right now, but so far they are balancing perfectly. Let us return to our initial question about how a company with massive top-line growth can burn through so much cash. The ultimate truth is that Equinix is ruthlessly monetizing the infrastructure boom with record-breaking bookings and expanding margins. Maintaining this market dominance requires an aggressive, debt-fueled capital expenditure cycle that cannot be paused, forcing them to sacrifice short-term free cash flow to build a digital empire that competitors cannot easily replicate. In stock market analysis, this valuation presents a compelling compounding machine rather than a value trap, provided you are comfortable with the debt. Equinix possesses ultimate pricing power and a massive protective moat, making their shares a solid foundation for capitalizing on the digital future. But I want to hear your take. Does the aggressive debt make Equinix too risky, or is it necessary to dominate the space? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.